Well, hello. Welcome back to F3. Now, as we discussed earlier, um, here I am. I think I found a new feature. You would definitely like it. See, it becomes like this. It becomes bigger and nicer. So, like we always do, we talk about the questions that we have, the sample exam questions, before we move to the next chapter. So here are the answers. So the first question's answer is B. I'm not going to explain the question. If you have any difficulties understanding these basic things, you can always ask me. The second is D, the third is D, and finally the fourth. That was a really good question. I really liked it. This also had the answer D. Moving on to the fourth chapter, one of the easiest topics that you'll be studying in F3, and also one of the most interesting topics that are going to stick with you for the rest of your life. You go to F7, P2, P7 in your real life, you will find this thing coming back to you all the time. It's a small chapter, so we'll discuss about this. Inventory is referred to as the goods that you have purchased or you have manufactured or something that you want to resell over the course of period, right? What is the year-end procedure of inventory? Now, inventory is recorded in your statement of financial position as inventory on the balance sheet, right? You count the inventory at the year end, you value what's the value of that inventory is, and you put that in your balance sheet. Simple. Is that too difficult? I don't think so. You work in a supermarket, what do? You go to the supermarket, you count all the things that are present in 31st December. Now let me give you some homework to do. If the next time you go to a supermarket, probably in June or maybe in December, depends what's the year end of that supermarket is, they will put some of the things that do not touch. Most of the things I've seen in frozen things, they won't touch, they would write there, do not touch for audit purposes. And certain times I've seen audited at this date, they would write this. If you're observant enough, you would have seen that already. Or if you haven't, keep this at the back of your head, and maybe you will just find it someday, right? Moving on, so valuing closing inventory. Now this is where IAS 2 inventories, the International Accounting Standard, was issued for inventories a long time ago. That hasn't been changed for a really long time, and I don't really see a reason why it needs to be changed anyway. So the first thing we talk about is IAS 2 inventory is that there are two ways. There are two things in IAS 2. So inventory is supposed to be valued at cost or NRV. So how do we call it? We say inventory should be valued at lower of cost or NRV, that's net realizable value. So maybe you have some chocolates left at the year end. The value of the chocolates is $1 for each chocolate. You have 100 chocolates. It's $10. It's $100 in total in your inventory. But you can't sell the chocolate for $1. You'd stated that if you buy 50 pieces on the spot, the delivery is free. Somebody ordered 100. Okay, no, 100. Let's say someone orders 100 chocolates. The delivery charges are $5 for 50 chocolates. What's the NRV for the 100 chocolates? 100 minus 10. 5 for 50 chocolates, meaning there are 100 chocolates. So there are 2 times you have to deliver the chocolates. That would be $10. Are we there? Do you understand it? So the NRV is 90. What would you put in your balance sheet? 100 or 90? 90. That's how you calculate the NRV. But instead, we have to take the lower one. But let's say for some reason your cost of the chocolates are 80, but the NRV you feel is going to be 90. I don't know how it's going to be 90. I don't even know how that thing is going to work out. But for the sake of argument, we say it's 90. So your cost is 90. The NRV is 80, for instance. I'm sorry, your NRV is 90, but your cost is 80. So what do you put in the balance sheet? The cost. you put lower just to be safe. You don't want to overstate things, right? Okay, this is a question. I want you to do this. Sit down there. I'll brief you on how to do it. I don't want to really make you worried about this question. It's a very easy question. You have to calculate. Okay, first thing in the exam tips, read the requirement first. It will help you make up your mind what you're going to face. Every time you're going to face, okay, I'll tell you, I play a lot of shooting games and action games that are based on shooting and stuff. And it really helps me relieve my mind off my bosses and all. I feel like I'm shooting them, so it feels good. But anywho, whenever I'm about to reach the end of a level, and there's a big boss, the person who is almost difficult to kill, almost impossible to kill, they'll give you tons of bullets. They'll give you tons of bombs. They'll give you tons of different variety of weapons. So it's the same thing. When you know there's a requirement, your mind makes up for things. It will make itself ready, take its weapons to shoot the question, to give you the answer, right? Now you have to calculate the closing inventory at 31st December 2011. So Denzel, that's a funny name. Sorry, Denzel, if any Denzel is hearing this. I doubt there would be any Denzels hearing it. But Denzel, that sounds fun to say. Denzel, Denzel, Denzel. Denzel runs a traditional sweet shop. Denzel, dude, you giving diabetes to people. You naughty boy. Having conducted a year-end inventory count as at 31st December 2011. He provides the following information. He had 3 inventories. I wouldn't normally do this, but I'm going to say the names. Bonbons. That's a good name. Bonbon. Spangles. Cola cubes. Cola cubes. I like cola cubes. Nice names. Okay. So do you have a few quantity? You see the unit price. Then there is a unit selling price. Okay. Now the unit price is your price. The unit selling price is your markup price. Now this minus this is your actually profit, whatever you earn from it. Then you have a unit selling cost. Now, just a hint, you need to think of selling cost for the NRV. Of course, I literally gave the answer away. So try to do this question. If you have any difficulties, let me know. Okay, there's another example over here that says calculate the cost of sale for inclusion in the profit in the statement of profit and loss. And let me draw a picture of profit and loss in front of you. You have revenue, you have less the cost of sales, and you break the cost of sales down. The first thing you have is add the opening inventory, you add the purchases, you add carriage inwards, then you do add of all the other bunch of stuff, then you minus the closing inventory. Then you come to the net cost of sales. In this question, they just don't ask you to give a straightaway answer for inventory. What they will do, they give you a bunch of things of what happened here, what happened here. You need to adjust your inventory, and then you need to start over again. Opening, add the purchases, change this figure, then you'll get the answer. Are we good? Good. So, yep, 2 questions that you guys need to do. Moving on, there are 3 methods to show the inventory in your accounts. There are 3 methods of it to calculate how to calculate the inventory. Number 1 is called FIFO. First in, first out. Now you make shoes. The first shoes you made may cost you $10, but the second shoes, the leather was expensive, there weren't many crocodiles you could kill. The price changed to 12. The first costed you 10, the second costed you 12. But in the accounts, when you're using FIFO, you say if the first comes in $10 for the first, if that came in, no matter which product I sold, I will assume that I sold the first one. First in, first out. Are we good? Then there's a weighted average. Weighted average is just a periodic way of calculating an average. If you did primary school mathematics, you know what an average is. You just take all the figures, you divide it by the number of units you're taking. For example, you're taking 10 plus 15 plus 20 plus 25. 4 figures, you add them together, you divide it by 4 because you have taken 4 figures on top of it. Simple as that. Then there's the last in first, so opposite of FIFO, it's called LIFO. I'll just explain you what it is. Americans like to use it, and it's acceptable in America, in the United States, but it's not acceptable in your accounting standards. In your IASs, this method is considered unacceptable. Probably why? Because last in first out means whatever came last, you throw it out first. But chances are the last in would be cheaper, the first in would be expensive. You buy an iPad today for $1,000. I mean, okay, that won't be for $1,000, $100. Okay, I'll just say $500. That sounds more realistic. You buy an iPad for $500. Then you buy another iPad for $400 and another iPad for $300. You keep buying iPads again and again and again and again and again. But when you say, I'll take the last one, I'll sell that first. Meaning the previous iPads, the price is depreciating for that gadget, right? That's the reason you're getting the iPads cheaper now. But you still keep them to show that your inventory is higher. How about that? That's the reason it's not allowed. But then you'll say, hey, why? FIFO means that I'm assuming that I'm taking out the thing that might be more expensive. Nobody cares. Your inventory is less, is fine. If your assets are understated, it's fine. It's not even going to happen. You're going to try your best to overstate your asset, isn't it? But it won't happen the otherwise. It won't happen the other way around. And there you go. There are two methods of doing the weighted average, a periodic method and a continuous method. Have I explained you those before? Okay, periodic method is just a simple unit average that I explained to you. Continuous method is a recalculation of the unit average following each purchase, meaning once you make a purchase, you take an average. Then you take another purchase, you take another average. Then you take another purchase, you take another average. Do you know what that is? A continuous weighted average method? Good. So now you guys have 3 examples to do. And this is how you account for in your balance sheet. Debit the inventory in the assets, like I told you, in the statement of financial position, and then your closing inventory in the cost of sales, right? Same thing, but this is a different format of showing it how it looks. Okay. Then you have sample exam questions. They're important questions, 3 questions mainly, and they're good. Next, we're going to be talking about irrecoverable debts and allowances for receivable. That will be another recording, guys. So you guys have 5 questions that you need to do. Thank you very much for listening. I hope it didn't take very long, and I hope you guys have a good day. Goodbye.